Okay, so we just got under, I think it's at 18 hours to go to the election polls opening tomorrow at 7 o'clock. And obviously the national elections tomorrow obviously have introduced significant uncertainty, to say the least, especially to the financial markets. And I think a lot of investors should just remember that elections are not the main driver behind stock market returns, although they do present unique opportunities. So this is one of the things I'm going to try and highlight in this presentation is investors are urged not to try and predict the outcome of the election or time the market. So we can all agree that this year, 2024, has above average political risk. The uncertainty about the upcoming election is unsettling, but it's also positive in the sense that it's a true reflection of, call it healthy democracy. So you can see there by the title there of today's webinar, should I take my money out of the stock market or out of the share market? I think a lot of people or some people are thinking, we're grappling with mixed signals. The share markets are navigating a period of uncertainty, and obviously risk appetite is showing signs of waning. So yeah, I'll go with that. I'll definitely agree that there is uncertainty in the market. But here's the agenda for today. So we're going to just touch on very briefly, should you take out the money out of the market? And then obviously 3 reasons why time in the market is better than market timing. And then we're going to talk about some value traps, as well as, or I can also say the other side of the coin is growth traps. Again, as I said just now, when the share market does experience a significant volatility, investors do get nervous. However, it's essential, and this is also something I want to highlight for you guys. It's essential to distinguish between losing value, which happens during market downturns, and losing money, which only occurs when you sell. So while market downturns can be unsettling, remember that losses are not realized until you sell. So historically, and we've seen this, obviously you can go back and you can look at charts and things like that. Historically, the stock market has outperformed cash over the long term. That's number one. And number 2 is obviously staying invested does tend to yield better results, as it allows you to benefit from market recoveries and compound growth. You'll see some of my charts a bit later. So let's get into the first little topic here. Should I take my money out of the stock market? And basically, as I said just now, it is 2024 is a big year for elections, with more than half of the world's population heading to the polls. So this has obviously resulted in investor uncertainty. I'm going to mention that word a lot. There's a lot of uncertainty, with many waiting for the election outcomes to be known before investing the money. So look, there's money sitting on the sidelines. I can tell you that now. A lot of money has been taken out of the markets and sitting on the sidelines, and there's this wait and see attitude. So yeah, the challenge of that is that in South Africa, this obviously just compounds the negative sentiment surrounding the country regarding economic performance, the poor governance, and obviously collapsing service delivery. We all seen the little meme or the joke going around. This is our last week of no load shedding. From Friday onwards, we're going to have load shedding again. So yeah, that's our attitude towards that service delivery. Share markets become volatile. Investors can get nervous. In many cases, this prompts them to take money out of the market and keep it in cash. In other words, park it for a while. And the word there is for a while. A few months, maybe most a year, but a lot of people get things wrong and they stay a bit longer there. So how smart is it to really sell shares for cash when the market turns? So while some trading strategies attempt to predict and avoid periods of underperformance in the share markets, the adage says that it's not about timing the market, but about time in the market. That has proven true over the years. And research shows that those who stay invested for the long run, well diversified portfolio will generally do better than those who try to profit from turning points in the market. And I'll tell you, I'm a technical analyst. I look at charts all the time, but I also believe in the long-term investment in the market. So it's important to consider, and this is again, everybody's different. It's important to consider your investment goals, your financial goals, your risk tolerance, and obviously your investment strategy before making any decisions about your investments. It's also always a good idea to consult a financial advisor before making any major changes to your investment portfolio. And just to highlight this little point before I move on to the next slide, Warren Buffett's favorite holding period for stock is forever. Okay, but he also he acknowledges that there are valid reasons for selling a share, and we'll get on to some reasons just now. Okay, so should I take my money out of the stock market? And in brackets, I can say, should I take my money out of the stock market? Because I am worried about the election outcomes in South Africa. I think a lot of people might be thinking that the elections, as I mentioned just now, but timing the market is notoriously difficult. Yeah, it's attempting to move into cash based on political events. Obviously, you're going to be missing opportunities for potential gains if the market performs well despite initial uncertainty. That's number one. And number two, investment decisions should be based on long-term financial goals. As I just said just now, and a lot of things I will repeat because I want to reinforce the idea. So the idea here is that it's not short-term political events that moves the market that obviously you need to make decisions on. Staying invested, you are more likely to benefit from the overall growth of the market over time. So South Africa has a history of political volatility and economic challenges. We all know that. So uncertainty around elections is not necessarily a new phenomenon. The market has shown resilience. Okay, it's important to remember that in the past, and continuing to stay invested could help you ride out short-term fluctuations. But moving into cash, it carries its own risks. And the biggest risk there is obviously inflation. You put your money in the money markets now, getting 5 or 6% when inflation is running much higher than that. So say for the short term, it's fine, but longer than that, your money's going backwards. Okay, but staying invested in a diversified portfolio, we're going to be touching on that also a bit later, you have a better chance of weathering market downturns and benefiting from eventual recoveries. Again, it's your risk tolerance and your investment goals that's important. Okay. Let's just want to highlight for you guys. This is a screenshot of the JC All Share Index. This is this chart I was talking about just now. This is a 5-year chart. I just want to show you what's been happening in the last 5 years. So way back here, if I can bring my little cursor in quickly. This was COVID. Okay, that was COVID, and this was when we went into hard lockdown. The market dropped. A lot of people sold out, and a lot of people did not get back in again. Okay, for a long time, until such time, ideally that's where the market would have broken even. So a lot of people would have waited for that there, but look at this opportunity they wasted. If you were in the market, especially if you're not trust with a rand cost averaging and investing on a monthly basis, you could have taken advantage of that. But anyway, so that low there, that was in 2020 in March. Okay, that low was at 40,000 points. Now, in recently, 2023, beginning of last year, we made a high of 80,000. So it's more than doubled. The market doubled in 4 years. So yes, we can see what's happening at the moment. The market's moving sideways in this little channel. Okay, it's above its moving averages. Okay, this is a 200-day moving average. It's bullish. It's above its 21. Sorry, this is a weekly chart. So this is a 200-week moving average, 21, and a 40-week moving averages. Okay, you can see at the top of the trend there. So yes, we could pull back. Okay, technically we could pull back to this support, long-term support trend line here. Okay, so it's expected, and we also could pull back to this long-term support trend line here. That movement down to there is about 8%. That movement down to this 200-day moving average, okay, is 13%. So that's a worst case scenario you can expect between a 8 and a 13% pullback, but it's expected. Okay, so technically it's on the charts already. Excuse the pun. Okay, so that's number one. And number two is that sorry, I just want to just highlight for you also the current position of the JC All Share from a valuation point of view. The current PE ratio for the FTSE when I say FTSE, Financial Times, the FTSE JSE All-Share Index is around 16.6 times. Okay. In comparison, the PE ratio for the S&P 500, which is the American market, is around 27.8. Okay, and the FTSE 100, which is the London Stock Exchange, is around 15.85. So based on these comparisons, the JSE is relatively cheaper compared to the S&P 500, but slightly more expensive than the FTSE. Okay, so that's number one. Number two, the PE ratio is below the S&P 500, can be considered more attractively valued in comparison to the American markets. Okay, so our market is cheaper than the US markets. Compared to the all-share, the all-world, the MECI all-world index, the index is a PE of 19.5. Again, we are cheaper. We're undervalued. Compared to emerging markets, however, they're sitting on a 14.48. So we're slightly a bit more expensive and obviously a bit more overvalued. So, but if you look at the performance of this is only showing you 5 years. If you look at the performance of the JSE All-Share over the last 30 years, there have only been 5 years in which the index reported negative returns. Over the last 30 years, there's only been 5 times where we had negative returns. In 1997, 1998, 2002, 2008, and 2018. None of those years coincided with a general election. So markets are cyclical, and short-term volatility also leads to fluctuating returns with no clear patterns, okay, even during repeat events such as election years. Okay, so obviously there are a lot of things that could happen. The average return on the JSE, by the way, for the last two decades, last 20 years, is 13% per annum. That's the average growth. So we have endured tough times before. Okay, so I should move on to the next slide here, which is the rand. Give you some more input there. We go. There we go. There we go. So there's the rand. So way back here in 2021, the rand was at 13 rand 50 to the US dollar. Okay, we recently in May, exactly nearly a year ago. A year ago, we hit 1938. Since then, the rand has strengthened. Okay, so yes, in this zone here, in this red zone, we are undervalued and we have to pull back. Yes, in the last few weeks and since April, we have pulled back. We're trading below those moving averages. Again, this is a 5-year chart. Okay, so again, we could, and this is opposite. The red line will be support. That's where the rand gets weaker, and the blue line is what we call resistance. So if we break down through this, we're getting stronger. So we could break through this, okay, through this resistance trend line and move down a bit lower. There's 18 rand, and we could move down to 17 rand 50. Okay, a lot of people are talking about 17.50 this year. So let's give you some perspective. Where are we in terms of those two things? So yeah, there's a positive election result. We'll see our JSE performing better. We're about 30% undervalued compared to the rest of the world markets because we missed out on the last bull run, and the rand also is undervalued. We can expect that to pull back and do much better. Okay, so to answer your question, what are the valid reasons for wanting to sell a share? Obviously, number one would be the investment outlook, or your strategy has changed. Let's say, for example, you invested in retailers, and obviously inflation where it is now and interest rates where they are now, those companies aren't doing so well because obviously people have less money, less disposable money in their pockets. So you might consider switching into other investments. Okay, so that's number one. So your strategy might change on that in that scenario. The company's growth prospects might have changed. You know, the strategic direction. We see what's been in the news the last few days is Pick and Pay. Yeah, we saw yesterday that they announced this 4 billion rand rights issue. We learned that the Ackerman family is stepping away from the chairman board, the chairman post, and obviously the voting rights and things like that. So there's changes. So that could be a strategy for the positive for Pick and Pay, for example. But you know, market reaction, it could be negative to some other events. So and that obviously will be in anticipation of the company's earnings getting weaker going forward and things like that. Company acquisition, we also see recently with Anglo's and Billiton's. Anglo's share price jumped up more than 20%. Billiton's share price actually went down. And obviously that was all about those merger talks and things like that. And that's all like slowly fizzled away. But Anglo's is still trading much higher. So you might have said, okay, leave it, take my profits at these higher levels. That's one of the reasons, you know. But I think the main reason for me would be because I want to rebalance my portfolio. I might be too exposed to certain shares, and my allocation is outgrown my initial call it setup. That's number one, rebalancing my portfolio. Also, I might want to be diversifying. You know, I might have too much exposure to South Africa. I might want to gain exposure offshore. So I might want to move into an ETF like a SATX the S&P 500, or might want to get involved in the Nasdaq. But diversifying. I want to sell some shares because I want to diversify into other things. I might want to have more exposure to the bond market and fixed income, for example. But also you're changing goals. You know, as you might get older, you might say, okay, I might want to move my retirement funds out of more risky stuff into more moderate stuff. You know, so you're changing goals. But you know, I always say people, you know, you should never ever sell out your investments because you've got an expense to cover. You should have, and I've mentioned this before in previous webinars, you should have a separate account for emergency funds. Okay, so changing goals could be one of those things. But as you know, if you have a long-term investment goal, that should what it be. It should be your goal. It should be a long-term goal. Rather have other investments for those shorter-term goals. I hope that makes some sense. Okay, so let's talk about, wrong way up, the 3 reasons that time in the market is better than timing. So we have spoken about this before. So, you know, time in the market is the same as speculation. So either you're an investor or you're a trader. So it's very important to distinguish between those 2 ways of making money in the markets. If you're a trader, rather look at things like derivatives, and your time horizon is much shorter. If you're an investor, your time horizon is longer. So that's one way to separate the 2 ideas. But also, as I said just now, you know, if you're investing in the market, your focus should be to remain spending time in the market. So in the words of Keller Fisher, some of you guys might have heard of Keller Fisher. He's an American billionaire investment analyst. Time in the market beats timing the market. So the saying has stood the test of time, and it's one an investor should always keep in mind. Research shows that those who stay invested over the long run in a well-diversified portfolio will generally do better than those who try to profit from timing the market, or take advantage of the turning points in the market. So it's virtually impossible to do this consistently. That's the thing there, consistently over the long term. Okay, so let's get on to the 3 reasons. Number 1, consistent returns. As I said just now, in the market, time in the market is important. You benefit from the long-term growth, overall upward trend. You ride out the market fluctuations. You have much potentially higher returns in the market. You allow for consistent returns and avoid the risk by missing out on those significant gains. As I mentioned just now with the COVID, a lot of people sold out and they were too scared to get back in again because they were too scared. Okay. So what are the big advantages is obviously compound returns. We miss that sometimes, you know, money making money. Okay. Second reason is lower risk. Okay, market timing carries higher risk of loss compared to staying invested in the market. Believe it or not, so people are saying, I'm getting out of the market now, I'm moving into cash, but there are risks involved there too. So trying to predict market movements can lead to missed opportunities. And I saw that with COVID. A lot of people missed opportunities there. Okay. And then lastly, obviously, it's more cost effective to stay in the market. Obviously, the main thing here is transaction costs. So every time you sell, there's costs. Every time you buy back in again, there's costs. That's number 1. And number 2, more importantly, there's tax implications. So if you had your investment more than 3 years, yes, there might be capital gains tax implications. If it's less than 3 years, there will be income tax implications. So again, it's very important that you be aware of those kind of things. So that's very briefly the three main reasons I would say is why you want to stay invested in the market. Okay. I want to highlight this. This is quite an interesting little exercise. Time in the market versus time in the market. Okay. So we believe, PSG, we believe time in the market and focus on your investment time horizon, that is the period that you want to invest for, is a better strategy. So here's an example. Let's consider two investors, one following a time in the market, that's Mr. Time, and the other trying to time the market, Mr. Timer. So the market timer, he wants to be invested in the best performing unit trust every year. That's what we call switching. Well, I'm amazing how many people actually want to do that and try and trade unit trusts. That's the way I see it. Okay, so the time in the market investor, he focuses on the long-term goals and ignores the dangerous short-term performance figures. So the table here shows the performance or the performance or growth of 4 different unit trusts achieved over a 4-year period. So this is all hypothetical and it's just for illustrative purposes. So in the beginning of year 1, both investors invest 5,000 Rand in unit trust B. Okay, for a period of 4 years, as the fund best matched the investment time period, number 1, and number 2, the risk profile as recommended by the financial advisor. So at the end of year 1, both received 8% return, growth on their money invested, and unit trust A had 10% return in year 1, which makes Mr. Timer but peeved. Okay, so he's a bit unhappy, and therefore at the start of year 2, he goes against the advice of his advisor and switches and buys unit trust A due to the performance in the previous year. So Mr. Time, however, follows the sensible time in the market approach and stays invested in the unit trust B, focus on his 4-year investment time period or time horizon, not trying to chase returns. Okay, at the beginning of year 3, Mr. Timer again switches. Okay, back into unit trust B, as this was the best performer in year 2. So the same thing happens at the beginning of year 4, as Mr. Timer now believes that unit trust C is a better fund. So at the end of the 4-year period, investment period, we can see at the bottom there, Mr. Timer is better off than Mr. Timer by following the time in the market strategy as opposed to timing the market approach. So they're one of the main drawbacks. And this is where people don't take into consideration. Applying the timing in the market approach is that most decisions are based on history, okay? And we all know past performance is not an indication of future performance. Okay, and what happened yesterday does not necessarily it will happen again tomorrow, okay? So what you do, what's important here, and this is the point, control what you can by sticking to your investment time horizon, number 1, and number 2, obviously your investment goals. Forget about timing the market and rather spend time in the market. I hope that makes some sense here for you guys. Okay, so let's talk quickly about the value traps. A lot of us have heard of that value investing. So value traps just goes one step further. It's about misleading investments that are trading at low levels. Okay, this is they might present buying opportunities for investors. Value trap is a share that appears attractively priced based on certain metrics like a low PE ratio. A value trap, the main thing here, it appears inexpensive relative to to its multiples, valuation multiples, but also to its industry peers, as well as obviously the prevailing market. As just now, the JSE all share was sitting at about 16. So a value trap can drop further. You buy in, and the next minute the share price drops a bit lower. So the idea you have a value trap. Okay, it could be a bargain, but just be aware. So there's 6 things I want to highlight for you. First of all, deceptive attractiveness, as I mentioned just now, they may have low PE multiples or low price to book ratios. They may have attractive dividend yields, and there's a lot of other positive indicators that might suck you in. Okay, there's also various other problems that you don't see. Okay, things like deteriorating financials. There might be management issues, changing industry dynamics, and things like that. But also what's important is there might be a lack of positive catalysts for growth. So there's no clear path for the rebound. We can talk about Pick and Pay again. And I was reading this morning about Pick and Pay. They only talk about going into positive growth in 2025, or 2027. So we've got 4 years to go before that gets turned around. So yeah, that's the first three there. Let's talk about the next three, sorry. Perseverance bias. This is where you hold on to the share in the hope that it will recover. Okay. Obviously this can lead to substantial losses if it continues to underperform, and you can link point 6 there very closely to that emotional attachment, and this will obviously cloud your judgment. There's a lot of sentimentality. You worked for the company once upon a time, the shares were given to you, you love the company, for example, but the shares are just dropping. I see that all the time. I talk to people from EOH. Okay. Historical glories. In the past it was a high-flying share. It was a darling of the market. I remember data many years ago. As I say, EOH is another one. There are quite a few in the market. So these are the traps that you have to be aware of that you can be sucked into. That's on the one side of the coin. Other side of the coin is a lot of times we don't think about this. There's also growth traps. Okay, this is where you chase the hot stocks. The companies are flying through the roof. The shares flying through the roof, and for a long time, you can talk about the Naspers of the world in the process. These are the big companies are flying, high flyers, the growth stocks. But the main thing here, you want to avoid what we call herd investing. You want to do your own homework. Herd investing, is a when everyone else is doing it, you want to do the same. It doesn't work always like that. So how to avoid it also? Invest into quality companies that have consistent numbers and things like that. So good quality companies. The valuation, if the valuations look too good to be true, they are. So just be aware of that too. And you know when to sell out of a overvalued stock. So we'll look at some examples just now. You guys need to make your own decisions. Are these companies worth it holding these stocks at these high levels? Okay, and then look into why the share is growing so fast. If the fundamentals fit, they're fine. But if it's just flying up like that on pure market sentiment, people just love it, they're pushing it. Look at a company like GameStop in America. Okay, that thing is, I can't even talk about the fundamentals. There's no fundamentals. Okay, so I want to highlight quickly, just for you, is it cheap or expensive? So I've broken down the next 3 slides. I've taken the top 40, the mid caps, and the small caps. So I've just taken the watch list from Viewpoint, and then I ranked them on the PE ratios. So on the top 40, I ranked the highest PE ratios. You can see a process. There's a 59.13 PE ratio. It's going to take you 59 years to recover the current earnings out of the current share price. So a lot of people say that's a growth stock. It's got a lot to do with Tencent and China and things like it. Yes, I understand it, but I'm a value investor. I won't touch the stock because it's overvalued. Okay. You can also look at the dividend yield. To me, I want to invest into a company that's undervalued and it's also got a lot of upside potential, and it's also going to give me a dividend growth. These guys are only giving anything dividends. Okay. Sibanye, Stillwater, 37%, sorry, 37 times, clicks and MTN. So these are on the top 40, I would say the top 5 expensive shares, put in inverted commas, expensive from valuation point of view. On the bottom side, okay, the top 5 undervalued companies would be Sasol, okay, on a price earnings multiple of 3. Very, very cheap. But what I like about Sasol, look at that dividend yield, 9% dividend yield. Exxaro, okay, we all know about Exxaro and coal and things like that, also very cheap. So yes, they're both mining stocks, might be out of favor. Look at ABSA. A lot of the banking stocks are undervalued. There's ABSA at 8. Sorry, should be 8. That should be a 6. Sorry, 6.8. That's a typing error there. That's 6.8, 6.39. It goes from cheapest to most expensive. Then British American Tobacco Company, 6.68, and then 6.94. Look at those dividend yields. So very great, very good dividend yield. So that's the top 40. Here's the mid caps. Look at Shaftesbury Capital. Yeah, I know it's an offshore company, but look at that, 241. Pick and Pay, we mentioned just now. They're in a lot of financial trouble, but also look at that PE ratio. I won't touch it. Okay, I won't touch it personally. Montauk Resources, yes, there's all the hype around alternative energy. 46, very high demand. Coulter, offshore company, PLC, might have a higher PE relative to its peers, and an IT company there, Buzz Technology. So those are high PE ratios. Look at the on the low side. African Rainbow, again, a resource company, Barlow's 7.89, 8.51, so it goes up. So these are the cheap ones based on the mid caps. And then small caps, most expensive, Zeta. Look at Zeta. Wow, 313. 313 years to carry the current earnings out of the current share price. Attack Properties, 24. Burstone, another property company. Imara property company. And PSG itself at 19. Okay. Good quality company. Obviously, the market rating is very high. African Rainbow Capital, very, very cheap. Motors, compared to We Buy Cars, Blue Label Telecoms. You can see these are the cheap small cap companies. Small cap companies. So a lot of these companies, for example, won't be paying out any dividends because they're reinvesting back into the business for future growth. Okay, so just be aware of those kind of things too. So that makes you a bit of an idea of a growth trap and a value trap. The reason I say that, there's opportunities in the market always. So yes, Sassel, this is our research we have available on our website. This was updated now the 23rd of February. We got a big buy recommendation on the company. We think there's a 91% upside potential. The share on the 23rd was trading about 146. We give it an intrinsic value of 279. You can see this is the share price. That's where the intrinsic value is. Look at that gap. So there's a lot of discount we can make up. So there's opportunities. Yes, it is bearish and things like that. That's back in COVID times. They dropped all the way down to 20 Rand. A lot of us rued that opportunity, missed opportunity, and we missed that opportunity, but we're very close to it again. You got to be back there, and the share goes higher. It's a good quality company. Here's Mr. Price. We're talking about retailers just now. He has a 21% upside potential, we think. He has intrinsic value way up there. So yes, the day has gone up. We might see a bit of a pullback soon on some profit taking on this little rally. It is bullish, but it's still, there's some upside potential. Might go as high as that there. Okay, the previous highs. But yeah, there's opportunities. And then lastly, Old Mutual. It's got an 18% upside potential. We spoke about this about a week or so ago. Great little company. And by the way, all these reports are available on our website, and I sincerely recommend go read up on the report and then teach yourself why we talk about these shares being undervalued and why is there an opportunity. Educate yourself. So there's the intrinsic value at 1350. This is where we're at the moment. So you've got also that little discount in the market. Okay. So I hope that made some sense for you guys. So just in quick summary, obviously when the market experiences volatility, we all get nervous. Again, I want to distinguish between losing value, which is expected in the market. The markets are cyclical, will pull back in value. And the difference is losing money. You lose money if you sell, okay? So avoid those pitfalls, rather stay in the market longer term. And then we have discussed this in previous webinars, sound investment principles, set investment goals, okay? Know your time horizon. So if your time horizon is long-term for retirement, have that time horizon always fixed in place. Don't get shaken by short-term events. Take informed decisions. Get some counseling get counsel from a financial advisor. Balance those risks. Understand your risks. Look at those fund fact sheets. Understand what is the risk with each particular fund, and then have a blended portfolio so you can manage that risk more to your liking. And then be patient. And I think this is a lot of things where people are not patient in the market. And again, as I mentioned just now, educate yourself. Go read up on those financial reports. If you don't understand what it means, go do go teach yourself more about fundamental analysis and technical analysis. And then lastly, just to before I handle any questions, the question right in the beginning: should I take my money out of the stock market? And the answer is no. Okay, not for short-term panic situations, okay, panic selling. Stay invested over the long term and a well-diversified portfolio. So if you're a long-term investor, have a long-term view. If you're a short-term trader, then have separate those different investments. Don't put all your eggs in one basket. We have spoken about that before in previous webinars. Okay, so let's quickly, yeah, obviously there's different investment vehicles for you to get to your goals. We have spoken about that before. And yeah, it's important that you, how can I say, sorry, let me just get my, there we go. So it's a different horses for courses, as they would say. So in conclusion, no matter what is happening in the markets at any given time, patience and common sense are usually the best approach. Okay, common sense goes out the window most of the time. If you aim to buy quality companies at the right price at the right time, you will likely get a better outcome in the longer term. Okay, so as Warren Buffett has said, and this is another one of his quotes, okay, price is what you pay and value is what you get. Okay, let me see what kind of questions you guys got here. Questions, cool. There's a question from Richard. Can I switch my funds in my retirement annuity to less riskier funds? Yeah, well, Richard, I'm not a financial advisor, so the best thing to do is to maybe get financial advice. But yeah, just think about it. You know, from an education point of view, you have to ask yourself some questions. You know, do I want to move into riskier funds because I'm worried about what's happening with elections? As I mentioned before, we've gone through this process before. However, it also depends on how many years you got to go before retirement. You know, if you retire next year, you know, obviously the whole way is retirement usually structured. You can't be heavily involved just in equities. I think the best case scenario is what they call balance funds. So you might want to move more to a moderate portfolio, or yeah. But the best thing to do is get financial advice. Okay, Richard. There's a question from Johan. What about using derivatives as a single stock futures to hedge? Well, it's an excellent idea. Yeah, especially if you've got a share portfolio. You know, if you do have the NASPASs in your portfolio and do anticipate the NASPAS is going to pull back 20, 30%, you know, I'd rather take out go short on a single stock future. So what you lose on your share portfolio, you make up on the short on the single stocks. So yeah, that's the whole idea about hedging. So it's that zero-sum game. Okay, yeah, it's a great idea. Gives you that peace of mind. So obviously calculate your exposure and then by the number of contracts. Okay, that will be equal the same. Oh, great. What other questions are there? At all? No questions? Talk about the need to calculate opportunity cost when sticking to time in the market. Opportunity cost. Flores, I'm not 100% sure. If you invested in a diversified portfolio, you hopefully invested in the best opportunities at the moment. If more opportunities come along, that's where it's also important. This is where I see it, is if you're putting additional money into the market and your dividends and things like that, that's what you want to take for opportunity in the market. I don't know if that answers your question for us. Sean, pleasure. SARS must also consider tax implications when selling. Yeah. So yeah, you're right. So yeah, if you held the share, especially on shares, if you held the share portfolio less than 3 years, then the receiver says, this is income nature, and obviously that all your profits will be added to your income, and obviously taxed as income tax. If it's longer than 3 years, then the receiver says, it's capital nature, and capital gains tax would apply, which is obviously much lower. But you know, don't sell because you're worried about the markets collapsing. You know, or they have a diversified portfolio. I hope that makes sense. I don't see any other questions. Yeah, it looks like all of it. Cool. Guys, thank you very much. I think, let me just move on to this last little slide here quickly. So yeah, these are all our different investment vehicles. I've spoken about this before. We just get this out of the way. We have various different, as I mentioned just now, call it horses for courses. A voluntary investment plan is great for emergency fund. It's great for long-term savings. You don't want to take money out of the market, out of your share portfolio or out of the market because you got a short-term expense if you haven't planned for it. Plan for those things. Have an emergency fund, 3 to 6 months expenses saved up. Retirement annuity, that's one thing I always say about retirement annuity. You can't get hold of it until the age of 55. Then you can only take a third out as a lump sum. The other 2/3 has to be invested. So it's for disciplined savings. And also, ideally, a tax-free investment plan should be also long-term. Should be allocated away as a way to complement your retirement fund. So I'd rather use vehicles like an investment, a VIP, a voluntary investment plan for short-term investments. Okay, so you might be looking at equity portfolios and also offshore. But these are all the different key investment documents that will give you more insight into what this is all about. So this webinar is being recorded. Hopefully I'll be able to send it out by Thursday or Friday, as well as the PDF of the presentation. And in any questions you guys have, you're welcome to give me a call. But from my side, happy investing into our webinar next month. All the best. Bye for now. There's my contact details. If you've got any questions, drop me an email at wealth@psg. Give me a call on 0860 000 368. From my side, thank you very much for being on this webinar. Until next month. Bye for now.